Are you struggling to pay back your student debt? Well, you're not alone. We're here to share some critical information that could save you a lot of money. Did you know that you have the right to pay back your student loans based on how much you earn, not how much you owe? The people who are supposed to help you navigate this system are called student loan servicers, and everyone has one. You might recognize the names like Navient, Fed Loan Servicing, Nelnet, or Mohilo. There's a bunch more out there too. There's a lot of jargon about income-driven repayment plans and student debt generally, and it can all quickly seem overwhelming. The Department of Education and student loan servicers don't make it any easier. But the key concept is that you have a right to pay back based on how much you make, not how much you owe. As long as you understand that, the rest should make sense. When you talk to your servicer, they can make this process even more confusing by telling you about every single option that exists, even if most of those options aren't right for you. We're going to put all that to the side today and instead focus on 4 income-driven repayment plans that are best for most people. Under these plans, your monthly payment is based on your adjusted gross income and family size, rather than how much you owe. That means your payments on these plans can be as low as $0 a month. So even if you owe $50,000 but earn what a typical teacher starts their career earning, you likely would be eligible for one of these income-driven repayment plans and could be saving $200, $300, $500 a month. This is particularly important for AFT members because this is the critical first step for anyone hoping to benefit from public service loan forgiveness. You can learn more about this at the Public Service Loan Forgiveness link at the top of the page. But let's talk about income-driven repayment plans real quick. The Department of Education has 4 of these repayment plans: Income Contingent Repayment, or ICR, Income-Based Repayment, or IBR, Pay-As-You-Earn, or PAY, and Revised Pay-As-You-Earn, or REPAY. There are a lot of details about these plans that can seem overwhelming. You can find great descriptions of all of them below the video. We're going to show you how they work. Let's meet Anna, who's earning the median teacher income of $58,030 a year, is married to another teacher, and has 1 child. She and her partner both have Masters of Education and owe $50,000 in direct loans as a result. Under a standard 10-year repayment plan, which is what the Department of Education puts you in when you graduate, she would owe $540 every month. So let's do the math to figure out how much she'd pay under Pay-As-You-Earn, the most generous of the income-driven repayment plans. Anna has a gross income of $58,030 a year, but this is based on her adjusted gross income, her take-home pay. In this case, that's going to be about $45,000 a year. What happens next is that the government looks at 150% of the poverty line for your family size, which they use to determine your discretionary income. For a family of 4, 150% of the poverty line is $31,170. You subtract that amount from her adjusted gross income, that means her discretionary income is $13,830. Because she's eligible for Pay-As-You-Earn, you'd multiply that number by 10%, which gives you $1,383. That's what she'd pay over a year. So you divide it by 12, and you'd see that she'll be expected to pay $115.25 every month. That's a lot less than $540. Enrolling in any of these income-driven repayment plans can seem complicated because of the different eligibilities for each plan, how similar the names are, and the confusing advice you might be hearing from your servicer. Don't worry. On the Department of Education's application for income-driven repayment, there's a box on question 2 that you can check that says, "Recommended. Place me on the plan with the lowest monthly payment amount." This means you don't need to worry about when you first took out your loan, when you got your last disbursement, or any of those things. You can start the process of getting into the very best plan for you today. Whether you apply online or use the paper form, this option is there. To apply, you just need to visit studentloans.gov and apply online, or ask your servicer to send you the paper form. If you do apply online, which we recommend, you're able to pre-populate your income information from the IRS, and it will take about 10 minutes or less. And if you just change jobs and your tax information doesn't accurately reflect your income, you can submit a pay stub in with your paper application. These plans are free to enroll in, and you should never pay someone to enroll you in them. There are hundreds of scam companies that will charge you hundreds of dollars to do this for you, and you should never pay them. Your servicer is paid by the Department of Education to help you with this free of charge.
Hey, this is Sam. Sorry I missed you. The reason I was calling was actually because your student loan servicer fell out of compliance by not telling you about the student loan forgiveness program. So for compliance and eligibility reasons, please call me back, 530-694-4290, so I can tell you what the Department of Education is going to offer you for your loans. Thanks again. Have a great day. Talk to you soon.
If you are contacted by one of these scam companies, file a complaint with the Consumer Financial Protection Bureau immediately at cfpb.gov. If you're feeling overwhelmed with your student debt, you're not alone. It's become a crisis in the United States, and it's time we admitted as a nation that we failed generations of Americans. That's why reducing student debt and tuition are key issues for the AFT. We hope this video will help with that effort. So join us in this fight and read below to learn more about what the AFT is doing to help solve this issue.